The debt ceiling is a critical aspect of the United States financial system, regulating the max amount of money the government can borrow to meet its financial obligations and fund its operations. It serves as a limit set by Congress on the total national debt that can be accumulated. The purpose of the debt ceiling is twofold: to prevent excessive borrowing and to provide Congress with a mechanism to control the country's borrowing capacity. By imposing a debt ceiling, Congress aims to promote fiscal responsibility and prevent the government from accumulating unsustainable levels of debt. This mechanism serves as a safeguard to ensure that the government does not rely too heavily on borrowing, which could have long-term negative consequences for the economy. Raising the debt ceiling has its pros and cons. One of the primary advantages is that it allows the government to continue borrowing money to pay its bills, preventing a possible government shutdown. This ensures the smooth operation of essential services and programs that citizens rely on daily. However, raising the debt ceiling also means that the government will continue accumulating debt, potentially leading to higher interest rates and inflation. The increase in borrowing may raise concerns about the country's long-term fiscal health and its ability to sustain its financial obligations. Well, what happens if the debt ceiling is not raised? If the debt ceiling remains unchanged or isn't raised, the government will be unable to borrow money to meet its financial obligations. This could result in a government shutdown, where non-essential services are temporarily halted. Additionally, failure to raise the debt ceiling could lead to a downgrade of the United States credit rating, which would have significant implications for borrowing costs and overall economic stability. The implications of the debt ceiling extend far beyond the government's ability to fund programs and services. It directly impacts citizens' daily lives and has broader consequences for global financial markets and investor confidence in the country's stability. The debt ceiling is a vital factor that shapes the financial landscape of the United States, and understanding its implications is crucial for ensuring a strong and stable economic future. Addressing the debt ceiling requires careful consideration and decision-making by Congress. Possible approaches include implementing fiscal reforms to reduce spending and increasing government revenues through taxation, as well as exploring more effective ways to manage the national debt. Finding a balanced and sustainable solution is essential to safeguard the long-term financial well-being of the United States.